to taxes. Chapter 2 is pretty much administrative stuff. Perfunctory chapter before we delve into the fine nuances of what is income and what are deductions and what are credits and all those other good things and nuts and bolts. Again, more of a background chapter, introductory chapter in 1, background in chapter 2. The IRS is a bureau under the Department of the Treasury, U.S. Department of Treasury. The president has a secretary for all the departments in the federal government. The Secretary of the Treasury oversees the Internal Revenue Service, the Alcohol, Tobacco, Firearms Bureau, a bunch of other bureaus that I'm not familiar with off the top of my head, but there are a bunch of them. And the head of the IRS is called the commissioner. And in fact, if you go to tax court, you don't sue the federal government, you don't sue the Treasury Department, you don't even sue the Internal Revenue Service, you sue the commissioner. Let me get some more lights on here. I have a little bit of a shadow, it looks like, on my screen. Be right back. Yeah, I don't know if that's any better. Better for the electric company running up my bill. Okay, as always, with every chapter, I suggest that you look at and spend a minute or two looking at the learning objectives at the beginning of the chapter, and then go to the end of the chapter and look at the key terms, possibly write those down as you go through the chapter, maybe define them if you're not familiar with them. Also, if you have the electronic textbook, when you read through the chapter and there's a word that's highlighted, I don't know if you know it, but if you put your cursor on that word, hover over that word and click on it, the definition will pop up. Okay. And again, the storyline is always good. All right, so let me see the page reference on this thing. Okay, 3. Taxpayer requirements. Not everybody has to file a tax return. If you look at Exhibit 2-1, this is for the book which pertains to the 2021 tax year. These numbers may be a little bit higher at present time because they are usually changed every year, indexed for inflation at a minimum. And if you have gross income under $12,550 in 2021, you didn't have to file a tax return. However, if you did work and earned less than that amount and your employer withheld money from your paycheck, you should file to get that money returned to you because there's no tax due. Okay? And the reason that limit is what it is because that is equal to the standard deduction. So if you have that much in income and $12,550 in income and your standard deduction is $12,550, your taxable income is 0. Now, as you look down the left-hand side of that Exhibit 2-1, there's different they say the filing status, but it's filing status and age, really. If you're over 65, the deduction is increased a little bit, $1,700 for 2021. I don't know what it is presently. The computer has all these numbers in it. And again, the numbers know that there's a threshold, a floor and a ceiling for these numbers, but don't focus on the number itself because, as I said, the numbers are indexed for inflation every year, and sometimes they're bumped up for other reasons. Okay, but basically what we have here in this exhibit are the 5 filing status: single, married, filing a joint return, married filing separate, head of household, surviving spouse, and then they throw in the thing if you're 65 or older or not. Also, I don't see it in here. They used to give you a little bit extra if you were blind. Okay, so that's the first thing we have to do with the if we get a client, somebody asks us to prepare their tax, say, are you subject to tax? Did you have any tax withheld? Even if you aren't subject, you can get a refund. And if you exceed those limits, then you must file a return. Now, the return date everybody knows is April 15th, unless it lands on a weekend or a holiday, then it is the next business day. Okay. Uh, if you are a corporation, you can pick and choose your tax year, and your due date is 4 months after the end of that tax year. April, if you're on a calendar year, April is the fourth month of the year, so it's due by the 15th of April. If your tax year, most retailers have a January 31st year end because of the Christmas season, December 31, and then the returns and the sales where they're trying to reduce inventory in January. So most retailers use a January 31 year end. So their return would be due by May 15th, 4 months after the end of their fiscal year, the 15th day. There is one exception if you have a corporation that has a June 30th year end, then it is due by September 15th, which is 3 months after the end of your fiscal year. I don't know for certain, but I would guess that that's because the federal government is on a October 1 through the following September 30th is the fiscal year that the federal government uses. Don't ask me why they chose that odd thing, but that's what they do. Now, the other thing, there's a lot of confusion about. Again, also pay attention to the key facts. I'm jumping the gun here a little bit, but since we're talking about who must file a return and the due date, you can get an extension to file the return by filing an automatic extension. I believe that is Form 7004, or is it the 86 something or other? Well, we'll get to that in a couple of pages, a couple of paragraphs. It's embarrassing not knowing the forms anymore, but the computer wiped a lot of that out of my brain. Used to know all the forms by heart. Not all the forms, but most of the popular ones by heart. The extension is only an extension to file the tax return. The tax must still be paid by the original due date. Okay. In fact, the form for the automatic six-month extension has a section in it to pay the tax that may be due and send it in with the extension. Otherwise, the extension is invalid. You also will be assessed fines and penalties if you don't pay the tax by the original due date. Okay. Now, you say, well, geez, if you're going to know what the tax is, you can do the tax return. Well, not really. If you're waiting for something or your accountant's backed up or for whatever reason, got a complicated return, you need an extension to file it. What you have to do is pay the tax or at least the amount. So you can always make estimated payments or a payment with the extension request, and better make sure that you have, you make an estimated payment and make sure that it's going to be equal to or greater than the amount of tax due to avoid interest and penalties. It will all come out when you file the return. Any amount you overpay can be credited to the upcoming succeeding year, or it can be refunded. So no big deal there. The only thing is it causes cash flow problems. And there's two safe harbors. You have to have enough paid in by the due date, the original due date, that is either 90% of the tax you're going to owe for the current year, so they give you a little leeway there, or an amount equal to 100% of the tax you paid the previous year. I like that one because it's a known quantity. And those two things are called safe harbors. Okay, the next topic they address here is the statute of limitations, and it is 3 years. The end of the second paragraph under that heading, statute of limitations. Um, for both amended returns, amended tax returns filed by the taxpayer, and proposed tax assessments by the IRS. So it works for the taxpayer and it applies to the service as well. The statute of limitations generally ends 3 years from the latter of the date the tax return was actually filed or the tax return's original due date. So unless you're under extension, well, or if you file early, that's when the clock starts. Oh, well, no, it's the latter of the original due date. So it's a little tricky rule there. It's, most people say the earliest of, this one is the latter of the date the return was filed or the original due date. So it's the original due date unless you're on extension, and then it would be 3 years from the date you filed if you were under an extension to file the return. And again, repeat myself, the extension only applies to filing the return, not paying the tax. The tax must be paid by the original due date. That may be a good exam question. Now, there are a couple of exceptions to the 3-year rule, the statute of limitations. One of them being is if there's fraud involved. If there's fraud involved, there is no statute of limitations. The IRS can go back as far as they can gather information on the taxpayer. Okay, also, let's see, if the taxpayer fails to file a return, let's see, for fraudulent returns, or if the taxpayer fails to file a return, the statute of limitations remains open indefinitely. Okay, it can also be voluntarily extended by the taxpayer at the request of the IRS to allow both sides sufficient time to resolve it. They'd like to negotiate things as opposed to going to court, because going to court is expensive, time-consuming, uses a lot of resources for both the IRS and the taxpayer. Very important thing under example 2-1, and I like this textbook because they give you very good examples and very good exhibits, a lot better than the ones that are found in the IRS pamphlet. The ones in the IRS pamphlets contain good, accurate information, but they always do it based on the IRS's interpretation of the law. They make the rules, they interpret them to their benefit. That may not always be the case. That's why there is tax court and regular court. All right. Underneath that example 2.1, very important paragraph, taxpayers should prepare for the possibility of audits each and every year. That means they should retain all supporting documentation for everything that's in the return so they can substantiate it, proving income and proving deductions. Now, I worked with a guy whose brother was an IRS agent, and we'd get together when they'd be around visiting. He was from the Boston area, worked out of the Boston office. Really, a fountain of knowledge. And they had a saying. He said, the IRS has to prove income, the taxpayer has to prove the deductions. But you're better off if you can prove everything, both sides. Okay, who gets audited? IRS audit selection. They have a couple computer programs. I used to get the CCH, Commerce Clearinghouse, Master Tax Guide every year. And in the front of the book, they would give you from the previous year the average deductions for certain itemized deductions. A lot of people don't itemize anymore since the Tax Cut and Job Acts of December 17, 2017. But for people that still itemize, it's important to watch those. In fact, the software, most softwares, if you are out of line with the normal average limit of itemized deductions or certain other itemized things, the computer will send the preparer an alert right on the screen, say this amount is, please verify this amount and make sure you have backup because it is out of the standard deviations from what the average is for that line item. Okay, and it's just a warning thing, and it's good, and you'll get experience doing these things, you'll know if somebody comes in with things. Of course, a lot of the itemized deductions now, there are limitations on the amount of mortgage interest you can deduct and real estate taxes you can deduct. And we'll get to those in later chapters when we encounter what's deductible and what's not. All right. They have a couple of computer systems. They have the DIF, Discriminant Function System, the Document Perfection System, and the Information Matching Program. And there's 3 types of audits. That's the more important thing, other than who gets selected. A lot of people say, oh, they only pick on the rich people. No, they pick on returns. They have so many returns they put in the database, and they have these logarithms in these computer programs that if something looks out of ordinary, out of place, it'll get flagged, and a human being will look at it and then make a decision whether the return will be audited or not. Now, let's see if we scroll down that page. Types of audits. Yeah, here we go. 3 types. The correspondence exam, they call them examinations. That's what the IRS calls them. Correspondence examination, office examination, and a field examination. And the names are pretty straightforward and self-explanatory. Correspondence examination is usually when something doesn't match up in the computer, they'll send you a letter. I've encountered this a number of times. I had an elderly couple that actually were my brother-in-law's parents-in-law, and I was doing their return, and one year they didn't give me a form. I don't know if they didn't have the form, mislaid it, or what. They had money in a bank in Nebraska because they could get a little bit higher interest rate. And these people were up in their 80s. And I get home one day and I get a phone call from them, and they're really, really excited and nervous. I said, calm down. We got a letter from the IRS and they want X number of dollars. I said, well, hold on. I'll be up after supper and, save the letter. So I said, calm down. It's not the end of the world, because I was afraid that one or both of them were going to take a heart attack. That's how nervous they were on the phone, sweating bullets, literally. And, not literally, figuratively. So I get up there and I read the letter, and, explain what happened. The bank, they had a certificate of deposit and it expired. And, it was $10,000, and they've got, $11,500 because they got their money back and the interest on the certificate of deposit. Well, they didn't send anything in, so the IRS gets the 1099 from the bank, and they know that they got $11,500, and they count that as income. I said, look, it's not going to be as bad as what they say, because the letter has, this amount and blah, blah, blah. You didn't report it. And that money was on deposit. So they go with the worst case scenario, and they say 0 as the basis of the certificate. So I said, well, you have any paperwork? Yeah, we got the certificate. We dug around. So they, like I said, they put $10,000 in the bank. I don't know, it was for 2 or 3 years. They got $11,500 back. So I said, you're going to have to pay some tax, but not what this letter says. And it's like $3,000-$4,000, which to them was a lot of money. And I says, no, you're going to have to pay, but it's going to be a lot less than that. It's going to be about $300-$400 maybe. So that's a correspondence letter. I get, again, usually get them all the time. Usually get them in the summer, around August. They start coming out when the computer matches everything up, and the IRS, because they had so many returns, they get around to getting these letters, sending them out. There's a real form to them, and there's a number of things you can do. You can agree with the IRS and send the payment in, or you can disagree with them in their entirety, or you can meet in the middle, say you agree with some but disagree with some, and then contact them. There's phone numbers on there, and there's also room for paperwork and explanations to go into it. Pretty straightforward. In an office examination, the second type of tax audit is where they send you a letter and they'll tell you to please come to an office, usually an office somewhat close. They wouldn't make somebody from Pennsylvania go to Texas or California, Chicago. Up here in Northeast, we have an office in Scranton. We have an office in Wilkes-Barre. They usually go to the nearest office. Worst case scenario would be having to go to Philadelphia, I guess, here in Northeast PA. And you got to go in. You don't have to go in. You could send your tax accountant or tax lawyer to act on your behalf. but they should have the records, and they'll go in there and they will sit down with the IRS and go over everything. The IRS will explain their side of things, you'll explain your side of things, or you or your representative will, and they'll resolve the matter one way or the other or something in between. The last type of exam or audit is what they call the field examination, and that's where the IRS agent comes out to your home or your place of business and parks there and may be there for months, maybe depending on the complexity of the return. To be a corporation tax auditor for the Commonwealth of Pennsylvania, I traveled into 4 or 5 years. I was doing that. I was in 27 states at corporate headquarters or where their tax office was. And these companies had a tax department that would prepare the tax return and then meet with the various taxing jurisdictions that would come in and audit them. And, they had a staff and a room in their office. And sometimes I was up in Connecticut one time at Stanley Works, the people who make the hand tools, and the IRS was there working in the same office at a different desk. And some of these companies will file in 20, 30, 40 states, plus the IRS federal return. And they have a whole staff of people that prepare them, file them, and handle the audits. Okay, so the next section is after the audit. What do we do? Well, you get, this is, again, a little confusing. You get a 30-day letter to either request a conference with an appeals officer who's independent of the case, they don't work on it, resides in a separate IRS division from the examining agent. You can, number 2, agree to the proposed adjustment. Okay. The appeals officer will consider the merits of the unresolved issues as well as the hazards of litigation. That is, they'll weigh, hey, do we have a strong case, weak case, or something in between? And should we go to court? Is it worth it? Or they're not going to go to court over $50. You're talking thousands of dollars, tens of thousands, hundreds of thousands of dollars. Yeah, they're going to risk going to court. And go to court, you always chance you could lose. They're very aware of that. And plus, they want to be as efficient as possible. And they'll negotiate a little bit, depending on how solid your stance is. If it's it's a lot of it is black and white. Some of it is gray. On the black and white, they'll stand fast because you're dead to rights. They got you dead to rights. And the stuff that's a little gray is subject to some interpretations. And again, you'll have court cases that explain the law. And if you got something to stand on, they'll look at it and weigh, what's our probabilities of prevailing. I had another client one time that got an assessment, was a retired state trooper. At one time, they couldn't get insurance, so they were self-insured with their fraternal organization. And they got a distribution, and their tax preparer, actually, I didn't do their returns, so I did their kids' return, and they got this letter, and they said, what do you think we should do here? We're not sure that this was handled right. And I said, let me look at it, did a little research. And it had something to do with having to retire when you're age 55. So it was like an age discrimination, because you'll see later on in the course, when you if you have an insurance or lawsuit, if damages and penal damages in a lawsuit are not taxable. Damages for loss of income is taxable. So, this was a violation of civil rights old age litigation. And I went through and I found cases that different tax courts or different circuit courts say yay, other courts say nay. And I said, well, we got a chance. So we wrote a proposal, and they got I think $11,000 back with had to pay about 20 or 30. So then you have the 90-day letter, okay? And again, you have a form there, 870, which signifies the taxpayer agrees to the immediate assessment and collection of the agreed upon tax and penalties. And then if you don't agree at that point in time, you can, the IRS will send the taxpayer a 90-day letter. Now, the 90-day letter starts the clock running on what you can do. Exhibit 2.2 shows you the process there in a schematic, so that may make a little bit more easy to understand than reading the text, the words. Now, the big thing to remember here is if you go to court, there's two places you can go to court. You can go to tax court, or you can go to the U.S. District Court or the U.S. Court of Federal Claims. If you go to tax court, the disputed amount does not have to be paid until the tax court hands down its ruling. If you go to the circuit court, U.S. Circuit Court or U.S. Court of Federal Claims, you have to pay the tax and then sue the commissioner of the IRS to get it back. Important distinction there. So obviously most people. Now, the other thing too is the tax court is a specialty court. The judges there only deal with tax court cases. The U.S. District Court and the U.S. Court of Federal Claims deal with all types of cases. Okay? And that's what it says. What I just said is what it alludes to underneath that figure of the schematic. And they talk about the federal judicial system. I don't know why they throw that in there. It's more, no, actually, tax is more law than accounting. I just showing you some background material about where you're located. You normally file in that area, but again, certain courts, you'd want to look at their records and see how they decide and maybe file in a different jurisdiction. Because and again, you always have the U.S. Supreme Court as a court of last appearing, although the Supreme Court justices pick and choose the cases they want to hear, and they're very, very reluctant to hear tax cases. They like to look at things that are broad and set precedent. Right. Again, you can look at the key facts there on the bottom of that page, and let's go up to the tax law sources. Okay, there's a hierarchy here. Okay, there's statutory authority. That is the tax code, which is the governing legal authority. Okay. In Exhibit 2.5, they give you the hierarchy. The top line you can see is the IRS code. Underneath that, you have various things. They talk about how the tax codes have evolved. Administrative authorities, the final regulations, temporary regulations, proposed regulations, revenue rulings, revenue procedures, private letter rulings, and technical advice memorandums. Those all emanate from the IRS, and they have pretty good authority, but less authority than the code. And then underneath that, you would have the case law. Under the U.S. Supreme Court, then the circuit courts, tax courts, federal courts, Court of Federal Claims, and U.S. District Courts. Okay. Secondary authorities. These are unofficial. Okay, but these are people that provide tax services to tax attorneys and CPAs. There's two big ones. It's called the Research Institute of America, RIA. The other one is Commerce Clearinghouse, CCH Master Tax Guide I referred to earlier. Those are in the italics there in the middle of that paragraph, just on the top of page 2-10 or bottom. I can't tell what the reference on these electronic textbooks. I see the page, and I don't know if that is anything above that is that page or anything below that is that page. I think it's anything above it is the page, because right underneath there I see 211, and it's one paragraph. So, Commerce Clearinghouse, CCH, Master Tax Guide, Research Institute, RIA, Federal Tax Handbook. And again, these things are like encyclopedias. The Master Tax Guide is a book about that thick. I may have one laying around. I know I have one in the office on campus. But they actually sell a subscription service every year, and it's a whole bookshelf set of books. It looks like an encyclopedia. It has a whole bunch of things. Now, the code, when you're doing tax research, you got to know how the code is set up and where to look. And it's kind of screwy how it's set up because they have all the, when you see people in court or on TV, they are quoting or section 43 subparagraph, and then they'll have the letter and the Roman numerals and the parentheses down and down and down to the minutia. Okay. Exhibit 2.6, they have some of the other ones. Besides Commerce Clearinghouse and Research Institute of America, or the BNA, I would imagine, there's tax news, or there's magazines or periodicals that may not be monthly, but they're quarterly or semi-annual things of people that are known in the field, are academicians that do research and offer their opinions on certain tax topics. All right. The tax code, if you go back into the history of it, could be a good happy hour discussion whether it's legal or not. The earlier attempts, the current IRS operates under was the code and authorization was back in 1913. Now it's been amended a number of times since then. The last major revision was in 1987, but they make minor changes year to year to year, especially with the dollar amounts for thresholds and limits and upper limits and lower limits of certain credits. Okay. Oh, there it's 1986 IRS Code of 1986 as amended. All right. The tax code things start in the House of Representatives in the Wages and Means Committee. Okay, so if we just had a new Congress come in early January, and they had the big fight over the chairman or the Speaker of the House. And the Speaker of the House's power is he appoints people, his fellow colleagues, representatives to various committees, and who's the head of the committee? Well, one of the major, most powerful committee is the Ways and Means. What the Ways and Means mean, the way we're going to raise revenue, and the means, how we're going to spend the revenue. That's a lot of, they more or less work on the budget. What are we going to take in taxes, and how are we going to spend it? That's the Ways and Means Committee. Exhibit 2.7 gives as a schematic. It's probably made a little bit better because you can see it visually instead of reading the words. It's always introduced in the Ways and Means Committee, and then it has to go to the Senate for approval. Okay. Then after the Senate approves it, it goes to the president's desk to be signed into law. Okay. If the Senate passes the act, both the House and Senate versions will be sent to the Joint Conference Committee and they will, if they approve it as is, then it goes to the president. If they make changes to it, then it has to go back to the Senate for approval, and then back to the Joint Conference Committee. That's, again, background information, not technically. Basic organization of the code. This is where you need to look at when you're doing research. Know it's something, how it's set up. Various sections will talk about what is income, what is an income, and what is, and we'll see this coming up in this chapter, next chapter. A lot of these definitions are purposely vague to give them the most power, and then the courts try to interpret this to try and put a limit on it. Okay. You can see chapter 1, subchapter A, section 61, 62, 63. Gross income, adjusted gross income, taxable income. All right, that's all in part 1, section 60s. Part 2, items specifically included in gross income. And then part 3, items specifically excluded. That's what we would want to know, important information like that. What is counted and what is excluded. You can, everybody, not everybody, but most people know that tax interest on municipal bonds is tax-free. Okay. There are other things, like they said, certain death benefits, insurance proceeds, gifts, and inheritance under a certain limit are tax-free. Interest on the sale of state and local bonds, tax-free. Okay, so They're a part of gross income, but not a part of adjusted gross income, not part of, more importantly, taxable income. So, it's funny. People would ask me, "Oh, what's income?" And there's an old saying that, well, I forget which Supreme Court justice said it. He said, just about every American knows what income is and what deductions are until you read the IRS code. Then you're not really sure. And there's some truth in that because it does get uh, rather involved at times. Tax treaties that governs international taxation. Some people that work in multiple countries, this applies to them. And where did you do the work that you earned the money? Even though they may send a check to your house here in Pennsylvania, if you worked in Europe or out on the high seas where that's a thing. You're working out on a oil derrick out past the 3 mile limit. You're in international waters. Well, who's going to tax you out there? And we come back to the courts that can have an impact on setting precedent on the interpretation of the statute, the IRS code. So then they talk about the administrative things that come out of the IRS, the final regulations, temporary regulations, and proposed regulations. 3 types of regulations, each having its own characteristics. Final regulations have been issued in file form and thus represent the Treasury's interpretation of the code. Okay, it's not law because Congress and the Senate haven't passed it and the President hasn't signed it. This is just what the IRS thinks it means. Okay, so regulations are where you have a better chance in court with the regulation, challenging a regulation, than you do challenging a code section. Code section is written law, and again, that's not to say you can't challenge it. It's subject to interpretation. That's what lawyers do. But the regulations, there's a better chance of you prevailing than when you're challenging a code section, unless something is glaringly wrong. Temporary regulations have a limited life, 3 years from the issue date after November 20th, 1988. So they're effective for the 3 years after they're issued. Nonetheless, during their life, they carry the same authoritative weight as a final regulation. And then we have proposed regulations, which allows the public to comment, and it's mostly tax people and taxpayers that would be affected by the proposed regulation. And they do not carry the same authoritative weight of temporary or final, but they do have some weight because it is coming out of the IRS. But again, it's only their interpretation. Now, underneath that, we have interpretive regulations. Okay, that's the IRS saying what they think the code means. Well, you, as a taxpayer, might read it and think something different. Well, that's where you need to get a lawyer who's a specialist and go to court and try and get the court to decide in your favor. Procedural regulations. They they relate to administering the code. Okay, those are things like we talked about: the due dates, the filing statuses, okay, the appeals process, the examination process. Okay. Legislative regulations, the rarest type, are issued when Congress specifically directs the Treasury Department to create regulations to address an issue in an area. We've had that since the pandemic. Okay, we suspended certain things. You don't have to do this. You don't have to do that. Okay. In these instances, the Treasury is actually writing law instead of interpreting the code. Legislative regulations. You can see there they quote a court case, Mayo Foundation for Medical Education and Research versus United States. The Supreme Court held, one of the few cases to get there, that all Treasury regulations warrant deference. It is thus a very difficult process to challenge any regulation, and taxpayers are cautioned not to take tax return positions inconsistent with the regulations. All right, revenue rulings are the second administrative authoritative basis for guiding tax preparation. They have less authoritative weight, but they provide much more detailed interpretation. And there's various ones. The letter ruling. An individual can describe the situation they have and ask the IRS to give them a ruling on applies to that. Of course, if it's made public, other people can try to get the same thing under the 14th Amendment, equal protection. Okay? So, private letter rulings, very specific tax issue. Determination letters and then technical advice memorandums follow in descending order. Now, the IRS is kind of a peculiar bird. They can acquiesce or non-acquiesce. They can actually, they're so powerful. If you go to a circuit court, U.S. Circuit Court, and win on an issue, they'll say that's only binding on you. Other taxpayers cannot cite that as precedent. That would be a case where the IRS has non-acquiescence with the tax court ruling. Yeah, the tax court ruled it this way, but we don't think they're right, and it only applies to that case, that individual taxpayer. Of course, lawyers can argue on anything. Okay. Tax research. You have a area that's not clear. You have a duty to apply the code as best you can, but that doesn't mean you have to go with the IRS's opinions or interpretations. As you can disagree with the IRS as long as, and this is ethics at work here, as long as you have a reasonable basis to disagree with them. Okay. So you can read the key facts there. There's a 5-step approach they recommend you follow when doing tax research. That is understanding the facts, identifying the issues, locate the relevant authority, analyze the tax authorities, and document and communicate the research results. Okay. Again, you could use the Commerce Clearinghouse or Research RIA references when you're doing tax research, as well as the code. As I said, the code, every example they give you is based on their interpretation and done to favor their positions, and you have to prove them wrong. Okay, the next several pages, they take each one of those 5 steps and expand upon it. I'm not going to waste time. You can do that as you read the book. And I think it's also touched on in the shell outline highlights I'll be sending out. And probably see it in the PowerPoints. I'll give an example of a letter the tax researcher sent to Bill and Mercedes. And then tells them what their conclusion would be. Here you go. The taxpayer and tax practitioner penalties. Okay, civil penalties. In addition to motivating good behavior via tax professional standards, the IRS can impose both civil and criminal penalties to encourage compliance by people that prepare taxes as well as a taxpayer. You prepare taxes for people, you are subject to these rules. Failure to file. They'll give you what the amounts involved there and the penalties. Failure to pay tax owed. Failure to make estimated payments. Just sent mine out this week. I'll have 4th one for 2022. Substantial underpayment of tax. They're subject to penalties for the taxpayer and violation by the preparer, because we should know better. Providing false withholding information. This might apply to the taxpayer, might apply to the employer if they make a mistake on your W-2 or your 1099s. Okay. And then if there's fraud involved, you can see that the penalties jump way, way up. Criminal penalties. You can go to jail for filing false tax returns. It's called fraud, wire service, wire transfer violations. Al Capone, they sent here. Yeah, he probably committed murder. He was a bootlegger, ran the gambling and other vices in Chicago during Prohibition, 1930s. He was sent to prison. You know, the, there's a old TV show, movies, Elliot Ness, the Untouchables. The way they got Al Capone, and actually they sent him to Alcatraz, and they got him for tax evasion. That's what he was in prison for, because he did not report all his income from all his illegal activities. Yeah, if you are a criminal, you rob a bank, that's income. That's taxable income. Now, I don't know of any thief who does that. Same thing. I know of one person in my old neighborhood, but they were a engineer, worked for PennDOT, but they also gambled, and they became a professional gambler, and that's what they put on their tax return as an occupation, professional gambler. And I would imagine there's a lot of those people out in Las Vegas now, more and more now that we have all these gaming uh, applications and online casinos and all that stuff. More and more people are doing that. Anything you do uh, in conjunction with that is deductible. Anything you do earn from it, win, that's your income. That has to be reported. Believe it or not, a little side bit, Pennsylvania Department of Revenue, marijuana is subject to sales tax. Every street dealer on the corner that is selling, I don't think any of them are collecting and remitting the sales tax, so they're breaking the law. They don't enforce it. How can you? But um, civil cases standard of conviction is higher than in criminal cases. Well, criminal cases you have a different standard. Criminal case it has to be proved beyond a shadow of a doubt. In a civil case, all you have to have is a preponderance of the evidence. So again, the IRS they're looking for the money. I'm not saying the only time they're going to put somebody in jail, but they'll do it if it's a high-profile individual in the community, because that'll put the fear of God in every other taxpayer who's thinking of hedging something, playing games with their income or deductions. They see a high-profile individual be taken to trial. They say, well, if they did that to that person, they're going to beat up on a little guy even worse. Again, substantial authority that supports the tax return position is key. Okay. All right, that brings us to the end of the chapter, because I just hit the conclusion. I was going back. I was going to talk about years ago in Luzerne County, there was a sitting judge given 1 year probation. He was a partnership in a silent partner in a Chevrolet dealership. The Chevrolet dealership paid for his lawn care, paid for his girlfriend's automobile, paid for his Penn State tickets, did a lot of personal expenses paid through the business that he co-owned with a cousin of his, a Chevrolet dealership. They, he was the big thing in the paper and the TV. This guy was arrested for tax evasion, and he's a lawyer and a sitting judge. I can't wait to trial so I can vindicate and clear my name, my good name. He goes into tax court and pleads guilty. They give him 1 year, plus he had to pay all the tax. That was only about $50,000. Not a whole lot of money given the money he had made. But they wanted to make an example of him. Most people, they would have said, hey, pay the $50,000, the interest and penalties on the amount that you owed, and we'll put you on probation. Because personally, I think because this guy was a judge and an attorney prior to that, a big shot in the community, high profile case, they wanted to get a lot of that out in the news media. And they'll usually do these things in February, March, or April, right around tax filing time. They time it, and they will get so much compliance from people who may have been thinking about fudging, cheating on their taxes. It is very valuable, a little bit sneaky, underhanded way, but the IRS is, it's a tough game. They're charged with trying to get 100% voluntary compliance again, trying to get 100% compliance on a voluntary basis. So they use whatever means they can. There's another case going back, 20, 30 years. The fellow from Scranton that brought the minor league baseball team down here from Maine, I forget his name. He was a attorney and a CPA, and he also taught taxes at the University of Scranton. He was so committed to getting that baseball team in here. He forgot to file his taxes for 3 years. So they, after he got the team down here, and he actually ruined his marriage. He was so dedicated and focused on that. Ended up getting divorced. Didn't file taxes for 3 years. So they arrest him, charge him, and the first day of court he goes in, and they said, how do you plead? You're charged with failure to pay taxes for 3 years, and they named the years. How do you plead? And he said, not guilty. And the judge was shocked, and the IRS agent there in prosecution, the U.S. attorney, is shocked. What do you mean? He said, you mean to tell me you paid your taxes for the years involved, 1977, 78, 79? He said, yes, Your Honor. He says, when did you pay them? He said, I just dropped them off now, because the IRS in Scranton is in the federal courthouse building. Some of it is their enforcement division. So yeah, on the way into court, he got in a little bit early and paid his taxes for the 3 years he didn't pay. So I'm trying to remember if they let him off or not. I probably gave him probation. I'm not sure on that case, but yeah, they'll do that. High-profile people, they like to give them time off. Getting back to the Luzerne County judge, he was towards the end of his sentence. His son was graduating from medical school, and he asked to be left out for one day, a Sunday, so he could see his son graduate, and they denied it. And he was pretty close to the end of his sentence, and they denied it. Because I would have been, I don't know exactly when they sentenced him, but I know he was pretty cool. He was like 10 months into a 12-month term, and they didn't do it. They want the public to think that they're mean and vicious. They are to a degree, but they're not. They're not unreasonable. Let me put it that way. If you can demonstrate and substantiate your case, they're willing to discuss. They're out there. They want to collect the money. That's what they're charged with. They want to collect the taxes and everything that's owed. Nothing more, nothing less. So again, when they're my dealings with them, I've never got anything past the correspondence level, but a phone call here and there. But we're able to resolve things in an adult manner. Respect them; they respect you. If you go in there belligerent, they're going to be hard as nails to deal with. All right, so I'll get this out, and I'll get some other stuff out on Chapter 2.